Hello, 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 hello. So we're back again. Been a while. Yesterday was supposed to be the first listening to some XT. Just so I'm on a different video. I was watching some XT and some backtest. Maybe let me know. Just that we can do something. That we can do something. That is something I can hear myself. But maybe I'm joking. Anyway, I can usually just with you guys. Let's see. Okay. Okay, let's see. Let me share this screen. Mm, okay.
I believed that we're going up here in detail, even though you've known about here, all the way up. And now we've already hit the first objective, which was that rejection block. If I was bearish, if I was bearish, if I was bearish, I would use that price to then look for a displacement lower. Now, please pay attention to what I'm saying, because I am not saying that I'm looking for dollar to go lower here. But because this is named a rejection block, I use that. It goes up to an old swing high and it trades to and through, which is that closing price. If it does that and then shows displacement, what does that mean? A small short-term 1 minute or 5 minute candlestick swing low is pierced. It does not need to close below it. And if there's a fair value gap above that, I'll use the 22 model essentially to get in and go short. That's how I would use the rejection block if I was bearish. But in this case, because I'm bullish on and I'm believing. Well, good morning, folks. Happy New Year. It is January 1st, 2023, and the first day of 2023 mentorship. First things first, a little bit of housekeeping. If you're new or if you're just beginning under my wing as a student of Smart Money Concepts, and one of the questions that keeps coming up all the time by new subscribers or casual viewers is, where do I begin? There's a lot of videos here, so let's take a look at what my opinion is. If you go over to the playlist button here, scrub over. If you are a Forex trader or a Forex trader in the making, this is where you want to start. Okay, the Market Maker Primer course, Market Maker series, and pattern recognition series. Okay, after you complete that, go over to Mastering High Probability Scalping, and then go through Scout Sniper Basic Field Guide, and then start the core content lessons here. This is the month 1, month 2, 3, 4, 5, 6, 7, so on, till you get to the last one. If you are wanting to go into the meat of everything that I'm going to be focusing on this year, which is primarily index futures trading, I will be doing commentary every day, Monday through Friday, or the equivalent thereof, barring personal schedule conflicts or holidays. For Forex, I'll be covering the dollar index, the euro dollar, the British pound, and I will be covering the index futures, ES and NQ. So every day I'll have my opinion shared as far as what I think on a macro view, daily chart, bias will be shared with you from my perspective. And then obviously all my engagements intraday will be on the index futures. So I'll be teaching with 2 live streams per week, going over real-time price feed. So that way you can study real-time price delivery algorithmically. and it is not a signal service. You will not see me press a button. I'm not going to do any kind of trading in front of you, but I will be calling the market live on a 1 and 5 minute basis. That way you can see there's a high degree of precision. Things that are algorithmic in price delivery, you'll see this repeating. And why only 2 times a week? Because it's going to be a up to 2-hour session. So if I'm doing 2 of them, it's basically 4 hours of crunch time that you got to go through. And the entire video will be uploaded for those that can't be here live when it happens, okay? So it's going to be a full plate of ICT goodness all through 2023. The second part is you're going to want to subscribe. I know some of you don't want to be on Twitter, but it's going to be a backup system for me. So while YouTube will have its live stream 2 times a week, that will be a varying schedule. It'll be based on the economic calendar, and you'll see what I mean when we get into February. This is my official Twitter account. If you go over to the YouTube channel, upper right corner, it says official ICT Twitter. Click on that. It'll open up to my profile. And then there's the pinned tweet here from October 5th, 2022 at 7:49 a.m. This is how you know it's the right account. Everything here, it should be self-explanatory. Okay, I'm not going to invite you into a Telegram channel. I'm not going to invite you into Instagram channel. I'm not going to invite you to Discord. I don't use it. I will never DM you, ever, and you can't DM me. Every free. I'm not doing an upsell. There is no future mentorship. I don't have anything else in the works except for 4 books. 1 is a fiction, and 3 are going to be educational. So that's the only thing you're going to get in the future with a price tag on it, and you don't even have to buy them. Okay, but it's kind of like my last soiree in paid mentoring, I guess, education. It's like my bullet point and final tack on the wall saying this is it. And good luck and enjoy it. We'll come back to this Twitter. Now, if you go over to the videos, I just uploaded 2 of them yesterday. I did the real quick rendition of my PM session trade on ES on Friday, last trading day of the year. And it's usually a very short vignette. I speed up the whole entire process of what I did. And most of you like that because it's real short and to the point. Sometimes I add music, sometimes I don't. And I annotate the video entirely. Well, I got lots of requests for, can you show the real time without any of the speeding up? So that's what this is here. And I have it set on playback 0.25 to show you that I had questions from folks that were saying, you know, is this really live or was it recorded after the fact? And I want you to see the last frame as I close TradingView. You'll see the system time matches the time of real-time data. Look in the lower right-hand corner. If you watch the lower right-hand corner, you'll see that the time on my computer matches the real-time data time. Just as I close TradingView. It's only there. There you go. So let me go down to the default. You can see it's 4:02 on December 30th. Okay. So, and you can obviously look at that on your own. So everything here was done live with real-time data through TradingView. If we go to profile on YouTube again, you go to the final trade of 2022 in real-time TradingView platform video. Click on that. Go into the video description. You'll see a link that takes me, or takes you rather, the viewer into a thread that was started and shared on Friday in the morning. So you can see the time, 7:41 a.m. is New York time, December 30th, 2022. I'm telling you right, I made a mistake. I said this is the contract month, and not correct. Yeah, right here. It's 7:42 a.m. And I walk everybody through the charts. Okay, so here's your daily chart. 4-hour chart. Noting the Thursday high and the low and the ranges thereof. And I go through, I don't want to steal the thunder from all for you to go through yourself, but I actually walk through everything on the morning beforehand of what levels I'm looking for, and you'll notice right here. Okay, let me scroll that real quick. Okay, at 8:20 a.m., there is your buy select people. Okay, all the levels down here, the market I'm draw into, but this is where I'm going to take your attention to later on, and you'll see what I mean by that by watching the video again and going through all the annotations here. Okay, so once you have that, you're going to want to subscribe to my Twitter. Usually I'm very busy on Twitter. I tweeted a lot in the past. I'm going to be only using this in 2023 going forward as like an alert to get your attention. Hey, look at this, to prompt you. In the event, it's not a live session. Now, on the days of the live session, obviously I wouldn't be doing any tweets. I'm not going to be doing any more Twitter spaces where I do it's kind of like a podcast. They're not going to be going on anymore. Okay, so you got the last one yesterday. So you want to have the notifications on for Twitter. So that way, anytime I'm alerting the subscribers to this channel on Twitter, it will be salient to real market events or something that may change. Okay, lower, it's not likely to have a big move higher. So that's how the chart looks when I'm doing my recordings. So you hear from the favorite list of things I like to work with. If you see it's not a lot of things, it'll allow me to go through and add all the annotations. Real quick, you'll see all that stuff that was in the recording and in the pre-markup, they're all there. Okay, that's what the chart looks like after the fact. Okay, so we talked about how the market would likely be an inside day on Friday. And this was Thursday's trading, and here's Friday. The reason why I kind of suspected it would be like that, and I tweeted it beforehand, the idea is that it's the last trading day. It's not likely to have a big move lower. It's not likely to have a big move higher. A lot of basically, institutional funds and money would be on the sidelines, not doing very much at all. If anything, squaring positions. Now the question is, what positions would be squaring? Well, if you look at what we've seen in December, it's pretty much been down. And we had no Santa Claus, quote unquote, rally, much like I said we wouldn't, and we would consolidate, which is what we would around in a small little range. I took everyone's attention to Thursday's high and low and said that we would be inside that range. It would be an inside day. That's Friday. We had a lower high than Thursday's high and a higher low than Thursday's low. So we're going to drop down into a 4-hour chart. Maximize this. And add the annotations. Okay, and trust me, we'll go through this. So here's the lows I'm focusing on that was based on Thursday and Thursday's high. Below old lows is sell side liquidity, basically sell stops. Above old highs is buy side liquidity, basically buy stops. That is liquidity. Okay. When we have a range, like from this candle's high and that candle's low, now if you're not looking at old highs and old lows for liquidity, you're looking for inefficiencies. For instance, like this candle's high, that candle's low. Only one candle passed between this candle's low and this candle's high. This is a buy side imbalance, sell side inefficiency. It is not a liquidity void. A liquidity void is an actual gap, like this. Between that candle's high and that candle's low, that is a liquidity void. Notice how the market goes back up above the short-term high here, right there, where did the bodies stop in this swing high? Right in here. I'm just going to borrow a line real quick. Okay, you see how the buy cycle above this short-term high was taken, but it was more specifically aiming for that liquidity void. Why? What had to happen there? In between this candle's high and that candle's low, we only have this single candle passing through. Which direction did it pass through between this low and this high? Down. So to balance this out, it has to go through it once. It comes up into it halfway. That's consequent encouragement. And then comes back up one full return. See that? We have a pass through down and pass up. This area here becomes a balanced price range once we leave it. So inside this 4-hour candle, we're going to leave this here. We're going to come back into it with a lower time frame. But just note that these levels here, in fact, let's change it to a heavy dashed line. And it'll make more sense when we get a lower time frame. No, it's ugly looking. But then we have inefficiencies in here that are actually seen on the lower time frame, as you'll see, which I walked through on the Twitter account on Friday morning. And I know this is probably a very complicated feeling already, but everything's like that when you first get involved in it. If you want highly precision-based trade executions and analysis, it's going to take a little bit of work, and it's okay. Just warm up to the idea that we're here together for the entirety of 2023, and I promise you're going to get a good looking. You have to show up every day, though, and take notes. All right, so we're going to drop down into the hourly chart. Okay, and we'll scroll back over here. So here's the low from Thursday's trading and liquidity there, and Thursday's high. So we have previous day's low sell side liquidity pool noted, and Thursday's high buy side liquidity noted. So if we're going to be expecting an inside day, as I was suggesting we would see on Friday, before the market got off and started trading in 8:30 and 9:30 opening, that whole premise of being inside day is relative to this high and that low. Meaning that we're not going to go lower if we didn't, and we're not going to go higher, which we didn't. So that's narrative, okay? That's not bias. Bias would be, which direction are you trading? Narrative is how is the day going to trade? And what's it likely to aim for as a result? That's not bias. Okay, it's a game plan. It's a roadmap as to what it should do. Okay, much like if you were traveling, you know where you want to go, and you know where you are. And if you've been there before, you probably have alternate routes in mind. You don't necessarily need to have a map, but with a map, you can articulate to someone that may have never traveled there from where you are multiple routes. Well, that's narrative. You can provide a narrative between point A to point B because with experience. In the market, that the market will likely drive towards one direction, liquidity higher or lower, based on a procedure, okay, or a list of events that would transpire before it would do that. What would be an example of that? Well, taking out a previous day's low just to run out the previous day's high. That's an extreme, but it can happen. The absence of something like that when there's low volatility expected would be staying inside the previous day's range. Now, if it's a Monday you're looking at and you're anticipating an inside day, you'd be referring to previous day of Friday, the previous last trading day, because we can't trade indices. So it's a matter of knowing what you're looking for and how it's likely to deliver in price. That's narrative. That's a little bit complicated, and it's going to take some time with me throughout 2023 to kind of get a feel for what that is. I don't always know exactly what the narrative is going to be. Sometimes I go in with an expectation it's going to do this or that, and I have to adjust, and I have to adapt to what the market's doing, because manual intervention can come in and upset what I believe the algorithm is likely to do. It doesn't mean that I don't know how to find another trade that would not necessarily be in alignment with that pre-market analysis or narrative in mind. It just means that I have to be, just like everyone else, adaptive to what the market's going to do. It's a living, breathing organism, okay? And it's going to make its decisions based on the people that run it. Okay, it's not buying and selling pressure that does it. So if we drop down into a 15-minute time frame, you can already see the signature split running up. Once it leaves, it comes back up. We'll go into that in a minute. Let's do a 15-minute chart. If you're new and all of this seems like it's going over your head, I promise if you go through all of the mentorship 2022, it's 41 videos. They're not all very long. It will help you understand what I'm showing here as well. But here's that real liquidity void where the market leaves it, comes back up, hits it, can't get back into it again. Why? Because now it's a balanced price range. The market moves lower and then drifts lower. And then we have all of our imbalances now from hourly chart, which was this to this. Let me go back up one more time. I'm sorry, I didn't do a good job there. An inside day, you'd be referring to, okay, and let's scroll back over here. So here's the low from Thursday's trading and the liquidity thereof, and Thursday's high. So we have previous day's low sell side liquidity pool noted and Thursday's high buy side liquidity noted. So if we're going to be expecting an inside day, I was suggesting we would see on Friday, before the market got off and started trading in 8:30 and 9:30 opening, that whole of being inside is relative to this high and that low, meaning that we're not going to go lower, which we didn't, and we're not going to go higher, which we did. So that's the narrative. Okay, that's not bias. Bias would be, which direction are you trading? Narrative is how is the day going to trade, and what's it likely to aim for as a result? That's not bias. Okay, it's a game plan. It's a roadmap as to what it should do. Okay, much like if you were traveling, you know where you want to go, and you know where you are. And if you've been there before, you probably have alternate routes in mind. You don't necessarily need to have a map, but with a map, you can articulate to someone that may have never traveled there from where you are multiple routes. Well, that's narrative. You can provide a narrative between point A to point B because you've been there with experience. In the market, there's a narrative that the market will likely drive towards one direction, liquidity higher or lower, based on a procedure, okay, or a list of events that would transpire before it would do that. What would be an example of that? Well, taking out a previous day's low just to run out previous day's high. That's an extreme, but it can happen. The absence of something like that when there's low volatility expected would be staying inside the previous day's range. Now, if it's a Monday you're looking at and you're anticipating an inside day, you'd be referring to previous day of Friday, the previous last trading day, because the weekend we can't trade indices. So it's a matter of knowing what you're looking for and how it's likely to deliver in price. That's narrative. That's a little bit complicated, and it's going to take some time with me throughout 2023 to kind of get a feel for what that is. I don't always know exactly what the narrative is going to be. Sometimes I go in with an expectation it's going to do this or that, and I have to adjust and I have to adapt to what the market's doing, because manual intervention can come in and upset what I believe the algorithm is likely to do. It doesn't mean that I don't know how to find another trade that would not necessarily be in alignment with that market analysis or narrative in mind. It just means that I have to be just like everyone else, adaptive to what the market's going to do. It's a living, breathing organism, okay? And it's going to make its decisions based on the people that run it. Okay, it's not buying and selling pressure that does it. So if we drop down into a 15-minute time frame, you can already see the signatures of it running up. Once it leaves, it comes back up. We'll go into that in a minute. Let's do a 15-minute. If you're new and all of this seems like it's going over your head, I promise if you go through all of the mentorship 2022, it's 41 videos. They're not all very long.
Yes.
It will help you understand what I'm showing you here as well. But here's that old real liquidity void where the market leaves it, comes back up, hits it, can't get back into it again. Why? Because now it's a balanced price range. And the market moves lower and then drifts lower. And then we have all of our imbalances now from the hourly chart, which was this to this. Let me go back up one more time. I'm sorry, I didn't do a good job there. This candle's high, that candle's low. That's your buy side and balance, sell side efficiency on the hourly chart. Now we can drop down into the 15. That's that same range there to there. But now we have more candles in it, okay? So I'm highlighting the fact that we have this range between this candle's high and that candle's low. That's this right here. Okay, I'm holding it so you can see the difference in the contrasting blue colors. Now, when I'm trading, and this is going to be a very difficult thing for me to get through, admittedly, I don't trade with anything on my chart. I see the levels, and then I work with them on the chart naked. I don't have any of this stuff on it. This is only to draw your attention to what my mind is considering salient to the market's delivery at the time of real-time data. So when I'm looking at price and I'm studying, if I'm looking for a setup or if I'm managing a position, that hinges on all these types of things. And while I may not have them on the chart, and that's why it's sometimes confusing when I show my examples, I have very little things on my chart because it's a distraction to me. But as a new student, you're going to want to need to see these things on the chart so that way you can respect the level of precision and how the algorithm will respond to them. And I'll explain more of that as we go. But we have a buy side and balance, sell side efficiency here on the 15-minute chart as well. And this yellow one, we'll see that when we drop down to the 5-minute. Okay, and here is the 5-minute chart. And we're going to scrub over here to same thing. This one candle here, it's high right there. That candle's high. That candle's low. That's what I'm highlighting, and that's what the yellow range is showing. Okay, so that's the 5-minute fair value gap. So what we have is nested PD arrays in the form of a fair value gap. The larger one here on the 4-hour, the hourly is with the trend lines, the 15-minute chart, and then finally the 5-minute chart. So reducing all of the things down to a 5-minute chart and these relative equal highs over here. We'll see that on a 1-minute chart. It'll align. If I move it here, it messes up the alignment I have for my 1-minute chart savings. So here we have it leaving that balanced price range earlier with that liquidity void, the real liquidity void. It leaves it, breaks low there, and comes back up and just says, I can't get back up in there, and even leaves what? That little gap between that candle's low and that candle's high open right there. And then it moves lower down into the hourly imbalance, digs in deeper into the 15-minute chart imbalance, and then into the 5-minute chart imbalance right there. And then you watch me record a 5-handle move using the volume imbalance, which you'll see when we get into a 1-minute chart. You can watch the recording on Twitter too. It was shared yesterday or Friday morning. And then we have a market dive lower, back into this old order flow here. Then it gets sloppy. And my attention was on the 38.64, which is how I left Twitter Friday morning. I said, note 38.64, the relative equal highs. Okay. That was also shared in the chart in the morning before the market started moving around a lot. Market trades down to the low end of that 4-hour imbalance, trades just a little bit outside of it, then hits the low. Look at that. That's perfect. That's precision. Market rallies back up into both the hourly, the 15-minute, and the 5-minute. And I'm extending all those ranges into time later in the day. So if we take our vertical line and annotate the 3 o'clock hour, which would be 1500. I apologize. I should have said this at the beginning, because if you're looking at TradingView, you always, no matter where you are globally, you always have the time settings on TradingView set to New York. If you don't do that, number one, you will not be in alignment with the algorithm, and you will not be in alignment with my analysis. You'll be hard pressed to find the things I'm showing you in the chart. It'll be confusing. I know it may be an adjustment for you, but trust me, the markets run on this time. Okay, forget anything else anybody's ever told you. This is what you use. Okay, so just scroll through on TradingView and make sure your time is always set to New York. Now for indices, if we're seeing daylight savings time effect, because every year they talk about how they're likely to do away with it. I wish they would personally, but whatever you're doing, if you're trading index futures, you're going to always use New York local time, whether it's daylight savings time or whatever. Okay, it's never an issue for me for trading Forex, but for stock indices, I'm going to be using it relative to New York time. Okay, and here is the PM session, 3 o'clock to 4 o'clock. This is a small little window of opportunity that if you are looking for just something that is going to be a real easy, small window of trading, you don't have a whole lot of time, and you want to just really go in there and look for something that's going to offer 5 handles or more. 5 handles would be like this. If you have a move, say from 36 even down to 31 even. Okay, that much of range is 5 handles. It's not much. And you can see having that, there's lots of opportunities to find 5 handles in all this movement. I know it probably doesn't feel like it's easy, but I promise it's there. It's very easy to do after you know what you're looking for. What is it you're looking for? Well, we had a buy side liquidity pool at 38.64. Okay, that's what this level is here. At 3 o'clock, what I'm looking for is a reason to trust. You all knew my attention was on 38.64. I'm not going to pull up the tweet because I want you to go into my Twitter feed on Friday and see it yourself and look at the time and the date stamp on it. I never, ever, ever delete a tweet. If I make a mistake and if I don't notice the error, invariably one of my students are going to say, hey, did you mean this, or correct it? And then I'll say something to the effect, or I'll like their post. More or less confirming, saying, yes, you understand correctly. Or if I noticed I made an error, I'll add, in addition to that tweet, I'll say, this is what I meant. Much like I did on Friday morning when I mentioned the incorrect contract month, because obviously we can't trade March 2022 contract, which would be in TradingView, the symbol you would use to pull it up would be ESH2022. Well, you can't pull up that contract because it's expired. So I made an error in calling that up. It's ESH2023, which is the front month right now for index futures, ES. Now, if you're watching video later on, obviously, you may not be able to see it. So just go through the tweets and you'll see the charts, and there it is. And the recordings obviously show everything here. All right, so after 3 o'clock, what I'm looking for is a reason to anticipate a move up into that 38.64. Okay, so we're going to take this off because it's just more or less me glad handing with the viewers on the fact that we went up into this area. So we have this 5-minute fair gap, which I'm going to bring to the forefront. Okay, so now we see this, and we also notice that in here, this movement here started somewhere. Where did it start? Well, we're already in the upper portion of this range from the 4-hour. So this range here, see that middle point? We're above it, which is what we want to see. Now, don't confuse that with, oh, you're going long in a premium. That's not a premium. That's not a premium at all, because we are now in the last hour with the expectation that we're going to run above that 38.64 because there's buy side liquidity resting above that. I drew everyone's attention. That's where it's going to go. Why? Because the likelihood of us seeing a short covering rally. Now, here's where my viewership gets divided, because some of you may have been trading for a long time. Maybe you learned from other people. Maybe you've adopted your own opinion about what the market does, what it doesn't do, how it books price, which things make it move higher or lower, what causes it to stay stagnant and go in consolidation. The market will rally because the algorithm keeps offering a higher price, and anybody that comes in at market, guess what they're getting filled at? That price. And as long as the algorithm keeps spooling, it's going to keep moving and offering higher prices. Initially, anyone short, they won't be swayed by that. But eventually, as it just keeps grinding higher, offering higher, and not allowing lower prices. It does not matter how many people are coming in going short. That doesn't matter. If the algorithm is going higher, it's going higher, and it's going to squeeze you out. Now, when it doesn't suit the trader or educator's narrative for why their pattern didn't work, they will fall back on, well, it's because there was a short covering rally and the market squeezed traders out, and short covering made price go up. No, the algorithm is pricing higher, and as a default, participants that are covering are forced to do what? Buy it back to get out of their short, because you have to sell it to get in first when you're trying to make it going lower. Well, anyone that's been short, as this is going higher, they're contemplating whether or not this is a good thing to hold on to. And with the last day of the year, and you want to be able to book your profit, so that way you have earned your capital gains, and now you can pay your taxes on it. This movement here is just going to keep driving higher and higher and higher, which is what I was expecting, what I outlined in the recording on Friday morning. And you're welcome to go through that video again with insights, that way you understand what it is I'm explaining. This is not buying pressure that drives it up there. This pool of liquidity above 38.64 is the pressure. Okay, the market's going to go up there because that's where the orders are. What orders? Buy stops. Okay, anyone that's short, they have a large pool of orders collectively around and just above 38.64. So the algorithm sees that as an old reference point. It cannot, listen to me, it cannot see your order. It can't see my order, but it knows by its coding that that old relative equal high, which is 2 old highs, which is what I drew out on your charts in Twitter. Go back and look at it. You'll see it's there, and you'll actually see there also, even in the morning trade where I'm trading. I make sure that is it's in the filming of the screen. I want to make sure that that's in there, because that was the real move of the day, getting up to here with the narrative that there's going to be short covering, and they're going to implement a buy model that takes price higher, and it twists the arm of traders, not because of their buying pressure. The algorithm is only a tick higher. And any movement down is going to be muted. It's going to be small little increments. How many down closed candles is there in all this? Not many. And when they're there, how big are they? They're not big at all. But all the movement and the magnitude and velocity is all on the up close, all the green candles, gravitating towards that pool of liquidity resting above 38.60. Okay, so we anticipate this occurring based on the fact that it's the last trading day of the year. People want to get their money, they want to get paid, and they got to square up positions. That means they got to get out of whatever they're in. And what's likely to be the bias, that's the directional aspect of the analysis concepts. It's this pool of liquidity. So all this movement down here, look, it went outside the 4-hour imbalance, and then it went right down to and touched it right there. Perfect. You can't get any better than that. There's no improvement on that. There's nothing you can add to that in terms of precision. It stops right exactly where I drew your attention to. This is during the lead up to the last hour of trading. Then we have the movement here. You don't have to be a buyer here. You want to look for that real easy setup, the real easy setup where everything's lined up perfectly. The market rallies, creates a small little imbalance right here. Now I'm going to take the 15-minute off to start cleaning up this little area in here, but I want you to kind of like recall where these things are. If you're doing it in your own too, but just for a tutorial and walking you through the mindset, and also giving you a whole lot of other things in this video that would otherwise be a very short one, because I don't want to do long videos in the future of 2023. I want them to be more concise, but when it's necessary, I'm going to have to obviously give you some banter. So it's needed. It's not that I want to make the videos longer. It's for you to understand more accurately what it is I'm trying to draw your attention to. So let's first get the 4-hour range off. Okay, so that takes that off. And we're going to take off the 15-minute. So now we're left with a 1-minute buy side imbalance, sell side inefficiency, fair value gap. Okay, look at this candle's. Now you're going to look right here at this number right there. Okay, this candle's high. What is that? It's 38, 39 and a quarter. Okay, 39.25. Just remember that. What's the low of this candle right there? 38, 39.25. Perfect. Did it one tick below it? No. Did it fall short of getting to the bottom of it? No, it went right to it. What about this candle right there? What was the low of that candle? We're looking at this number right there, okay? That low is 38, 39 and a quarter. What about this low right there? Right here on that candle. 38, 39.25. Folks, that's perfect. Okay? That is absolutely perfect. You cannot argue. You cannot improve upon. You can't say anything could have done it better. I outlined it real time. It was recorded. It was executed on, and you seen the delivery. Okay? If there was not an algorithm, price wouldn't do that. My stop loss was placed just below here, right at that candle's opening. Why? Because it's going to respect that 1-minute fair value gap, because we've already did what? This is the hourly. This is the low of the fair value gap on the hour. This is the high of the fair value gap on the hour chart. So I watched as it went down. We went through it to touch the top here. We hit it. I bought it first at the top of the fair value gap using that right there. I wanted to go in with that, and then I added more, and then I added it one more time just to show you that I was not fearful of the stop being hit, because that 60-minute fair value gap is now going to support it, because we've already closed in the 1 minute. There's no need for it. There's no need for it. Why? We're also running out of time. It's 24 minutes. 24 minutes after, 25 minutes after 3, or 15:25. So now the market's going to have to start doing what? Gravitate towards that liquidity up here. Short sellers are going to want to cover, and they're going to be enticed to cover because of the algorithm repricing higher, 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 higher. When do I know it's really going to kick off? Once this shows all the bodies being unwilling to close at the low end of that 60-minute fair value gap. Once I see this, I'm waiting for the market to want to leave this area and starts to move here. And then right there, this candle, that's exactly what I'm looking for. The market's starting to break away, take off. A lot of acceleration. Once it does this, it creates another, what this is here, a fair value gap. But this fair value gap is likely to stay open. What does that mean? Much like this gap here, I mean, just for the second here, I'm going to darken it up a little bit. Okay, between this candle's high and this candle's low right there, that's what I'm shading in as a rectangle. The market comes completely down, fills that in right there. And it does it again here, and it does it again right there. Perfectly. Perfectly. That's not support and resistance. That's not Wyckoff. That's not supply and demand. It is absolutely the algorithm. Okay? And once it does this, it completely closes that in and then leaves it. But it starts off another fair value gap right as it leaves this one. So it's not going to do what? It's not going to be consolidation, expansion, reversal. It's going to be consolidation, expansion, and continue. It can consolidate and then run higher, but it's not going to consolidate, expansion, come right back into a retracement. That's not what it's going to do. The algorithm's going to leave area open. And you watch me do 2 examples of it this week. I identified it before it even proved to you as the viewer it wasn't going to go back in and close this range in or overlap what you see here. This up candle, that range between this candle's open here and this candle's low here, that one single up candle, green one. Let me take this off for a second. This one candle gets overlapped right there. So it's going up. It has to do what to